with our guest presenter today, Jeffrey Werner from Werner Consulting Group. I'm Caprice from Tensoft, and I'll be just giving you a few little housekeeping items here at the beginning, and then we'll move on to the agenda. So we're going to start with just some initial information and housekeeping items, and then one of Tensoft's co-founders and CEO, Bob Scarborough, is going to take just a few minutes to tell you about Tensoft and what we do. And after that, Bob will introduce today's presenter, Jeffrey Werner, and turn the floor over to him. And after the presentation, Jeffrey's going to answer as many questions as he can. And any remaining questions, do feel free. We'll be gathering questions up. Jeffrey will answer them via email, and we'll also be posting them to the website, to the Tensoft website afterwards. So do feel free to send those in at any time. And if you have questions during the presentation, anytime you think of something, go ahead and submit it using the question and answer pane over to the right. Just type those in, and Jeffrey will get to those as soon as he can, and again, as many as he can. And then the CPE certificates. I know a lot of folks who are attending today would be interested in getting those. So anyone who is eligible, and that is the eligibility requirement is that you attend the entire session and that you answer the polling questions that we'll be putting up periodically. So as long as you complete that, the CPE certificates will be emailed to you at the end or by the end of business Monday, the 4th. Hopefully we'll get them to you before that even. And again, submit your questions during the webcast or after the webcast to Jeffrey Werner. His email address is right there. And you can also submit them to me, and I'll get them over to Jeffrey. So that's it for the housekeeping items. If you have any problems also, shoot me a little message during the session and let me know, and I'll try to help. And now I'm going to turn it over to Bob Scarborough. Bob?
Good morning, everyone, and welcome today. And we'll just cover a couple brief items and then get on to Jeffrey and the content for today. So we're pleased to sponsor this event. It's a lot of this is really how we participate in the market and how we stay current ourselves, and how we work to make sure both our customers and future customers are taken care of, is by really understanding with and partnering with thought leaders like Jeffrey Werner to understand both the current needs and the future needs for revenue recognition. So we are a business software provider focused on technology companies, and we do have a software revenue management and contract billing management suites that focus on the technology industry. Yeah, I think that's probably let's just go on to the next slide here. Okay. So for our Tensoft, the revenue management, the revenue cycle management suite has the revenue manager and the contract billing manager options. And we do support a distinct or separate go-to-market model. So we look to understand how you sell to your customers to capture the appropriate transactions, including multi-element arrangements or contract sales in the appropriate manner. And then we do allow you to have a workflow and a fair value allocation and revenue rules management around the revenue agreement to support both a basic level as well as a more complex level of revenue recognition requirements. We do support the current GAAP requirements, and we'll be supporting the new revenue recognition standard as well. So we can move forward to the next slide, please. And so this is a graphical presentation of the data flow, and it's really in three major steps. The gray area to the left where it talks about the website or the CRM system where your sale may start. It could start in the Tensoft contract management or contract billing module. It could start in your ERP system as a sales order and invoice or return. And so capturing the appropriate transaction is really step one. Step two is to take the contract sale or multi-element sale or appropriate sale and format it correctly in our revenue engine by attaching a workflow to it, doing a fair value reallocation if required, and attaching rules to the lines. And then step three is really to take that consistently auditable, trackable, controlled process of taking the sale and turning it into a revenue agreement and putting it into your subledger where we can compute, post, report, analyze, and really make revenue recognition as controlled and as seamless and as manageable, and confident. That's something you can be confident in the quality of the results there as possible. So next slide, please. So at this point, I'm pleased to introduce Jeffrey Werner. And Jeffrey is an acknowledged expert in the area of software revenue recognition, providing revenue recognition consulting services to software and technology companies since 2001. Prior to launching his consulting business, Jeffrey was the CFO for Antrim Design Systems, a mixed signal synthesis company here in Silicon Valley. Before that, he was VP of Finance for Telepost, a web-based communication services company based in Santa Cruz. And earlier in this year, Jeffrey spent 11 years at KPMG Silicon Valley office, where he was a senior manager. Jeffrey regularly teaches software revenue recognition classes in the San Francisco Bay Area and with us. He has over 15 years experience helping companies with revenue recognition policies and practices, and he has an active practice of helping people with the revenue recognition process flow and complexities. So Jeffrey, the floor is yours.
Thank you very much, Bob, and welcome to everybody to our webcast today. We're going to be discussing the new revenue recognition standard, revenue from contracts with customers. So welcome to that. And we've got a number of people on the call. I think we'll leave it open just for a few more minutes before we take our first polling question for attendance. This is the agenda for what we'll be discussing today. We'll have an overview of the new standard, what it is, who did it, when is it happening, where is it, and why. Look at the process and scope of how the standard came into being. Look at the outline of the new revenue standard. There's 5 new principles of revenue recognition that we are going to discuss that are the new revenue recognition of the future. We'll look at the differences between a current USGAAP and the new standard, talk about some of the implementation issues and the changes and the effects of those changes from the new revenue standard on technology companies. So that's our agenda for this morning's webcast. And again, as Caprice mentioned, you're welcome to put any questions that you might have as we go along into the chat function in the GoToWebinar software. And we'll try to answer those as we go along or at the end of the webcast, or if not that, then by email or in our blog on the Tensoft website. Again, if you want to receive CPE credit for attending today, you need to answer the polling questions and be logged in. In addition, we send out a survey, I believe, at the end of the webcast, and if you could return that and answer the questions, it helps us comply with the organization that allows us to provide CPE credits for you. So that would be really helpful for us. Maybe we could do our first polling question and then move on with our agenda for today. And our first polling question is, will the new revenue recognition standard have a big impact for you and your company? So yes, no, or not sure. So the polls are open, and let's get our not sure is initially our largest category. My eyes aren't so good today, so it's hard to see that. But no does not seem to be a winning answer in this initial polling question. So And you can go ahead and close that when you feel like we've got the appropriate response there. And I'm going to move on with the slides, and with today's presentation we'll be having more polling questions as we go along. So one of the questions is, so you to understand what we're talking about today, who's issuing this new revenue standard? It's jointly issued by the FASB in the United States, which is the entity that issues accounting pronouncements and guidance for USGAAP in any company that follows USGAAP. It's also being issued jointly with the International Accounting Standards Board, so it'll be the GAAP, if you will, or accounting literature for the rest of the world. So it'll be part of USGAAP, and it's going to be part of IFRS when it's final. One question that a lot of people at least have initially is whether this is only going to take place if the U.S. adopts IFRS, and the answer to that is no. The question is not if we're going to be adopting this, but when, and we have adopted it, although the adoption date, as we'll see, is still a bit in the future. So what is the standard? Well, it's a really lengthy 217-page document. It was updated in July of last year, and then again this year, and it's finally been issued by the FASB in June of, what was it, May? It was May of 2014. You can get copies at FASB.org, and is now also part of the accounting standard literature, ASC 606. So 605 has been our codification area for the revenue recognition existing U.S. GAAP, and 606 is the new GAAP that's not currently effective, but we need to know about, and that's where we go to look at it. So it became final, as I said, in Q2 of 2014, and the expected date for most companies is their fiscal or calendar year 2017. And as I mentioned earlier, the new standard, when you adopt it, is going to be required accounting both for the U.S., for the U.S. GAAP, and in countries that are following IFRS, approximately 100-plus countries worldwide. And why is this happening? Well, it's part of an ongoing process to align or harmonize accounting worldwide. If you've been involved in accounting, 15, 20 years ago, almost every country had their own accounting standards, and so it was a really mixed mash of different ways of presenting financial statements. That's coalesced over the past couple decades to two predominant systems, US GAAP for US companies or US registered companies or other companies around the world, and then IFRS for most other companies. The two standard bodies decided to work together to issue joint standards, so even if everybody isn't on IFRS, if they're on either US GAAP or IFRS, they're using the same revenue recognition accounting standard. And it's to establish one comprehensive revenue recognition approach for all customer contracts. In US GAAP, currently we have dozens of different approaches, whether you're a software company, a technology company, a telecom company, oil and gas company, an entertainment company, all have different revenue recognition standards, and this is moving everybody into one methodology. The goal is to remove inconsistencies between different industries and different companies in the same industries, to improve comparisons between companies, and to provide more information and disclosures about how the companies are doing their accounting and presenting it in their financial statements. The goal of simplifying accounting and guidance, while lofty and maybe reachable long-term, in the short term, it's going to make things a lot more complicated because we're going to be moving into new ways of doing things, and that's always very, very challenging and complex as we do it. The process, it took years of discussions, about 15 years. There was an exposure draft in June of 2010, followed by a comment period, and a second comment period, final standard issued in May of 2014. And then one follow-up item that's starting to just take place is this transition resource group, which is a group of people working with the ASCPA and the FASB industry leaders, accounting firms, to examine various aspects of the new standard, discuss them, and perhaps even come up with consensus of what the gap for them or the best practice approach for those is. So the Transition Resource Group, the TRG, people are calling it, had their first meeting in July, and there are digests of that out on the internet from the TRG and the various accounting firms that have attended and issued updates. So that's what we're looking at for the standard and the process of how we got to where we are today. Now, the scope of this, as I mentioned, it's going to be all contracts with customers, whether you're a software company, an entertainment company, an oil and gas company, a biotech company, a technology company. Everyone's going to be covered under the same new revenue recognition standard. There are a couple carve-outs, insurance, leases, and some financial instruments will follow different accounting. There's a lease project that's going on with the FASB and the ISB for a joint lease standard. So you watch for that if you're in the lease area. But other than these three groups, it's pretty much every company is going to be impacted by this new standard. There's adoption methodologies and disclosures that are required, and no early adoption is permitted for U.S. companies, USGAAP companies. There is one exception for IFRS companies, as I best understand it, which is that if you are adopting IFRS for the first time before the adoption date, you can just do it one time with the new standard rather than implementing IFRS and then adopting this new revenue standard a year or two later when it becomes required for all companies, either USGAAP or IFRS preparers. So the two methodologies that you can use to adopt the standard are the retrospective adoption. This would mean that in 2017, when you adopt the standard, you would need to present in your financial statements the comparable periods. If you're a public company, that would be 3 years, so you'd need 2015 and 2016 to be restated under the new standard, and then present all those periods as if the standard had been in place and followed in all 3 years. That way you have comparable financial statements. This, of course, implies that during 2015 and 2016, you either track your revenue in under both systems, or you go back and restate 2015 and 2016 before you issue your first financial statements in 2017. If you're a quarterly reporting company, that would be your first quarter of 2017, or if you're a private company that only reports annually, you just have to do that when you do your annual financial statements, and perhaps you would only have to do 2016 and 2017. But that's quite a substantial effort, given that your revenue is most likely your largest item in your financial statements, and is, unless you have very few transactions, could be a significant effort. So while the two standard bodies initially were arguing for an exclusive retrospective adoption approach, they did finally, before they issued the final standard, agree to a simplified transition method. And under this method, at the date that you adopted, so if your calendar year company, January 1st, 2017, you'd record the cumulative effect of the change on the balance sheet. So if you had any contracts that were, still had deferred revenue or were active that came from 2016 or a prior period, you would have to restate those contracts, do the cumulative effect on your balance sheet, and then disclose the amount of the change and each item in your balance sheet and income statement that did change. You would also then, during the remainder of 2017, when you issued your quarterly statements, or if you're just an annual reporter, you'd have to show the difference between the new and the old methods in the year of adoption in 2017. So while this may be less onerous for a lot of companies, it is still a lot of work. I'd also like to mention that if you are a a public company or if you're a company that has shareholders or creditors or other folks that require financial statements, given that the financial statements that you present in 2017 under the new standard may be significantly different from your existing financials, you've got some significant work there to educate your viewers of your financial statements as to what those changes are going to be, and also within your organization to be able to forecast and predict what your 2017 revenues are going to be if you're making those sort of forward-looking statements under the new system. So it's going to be pretty interesting and a lot of work to do this. Let's take a look at what the new model is, the new standard, and we'll contrast that with our current revenue model in the United States, where we have our 4 general principles of revenue recognition. We have evidence of arrangement, that the fee needs to be fixed and determinable, that delivery or performance has to have taken place, and that collectability needs to be assured. And so those are the guidance that we follow and have been following for 15, 20 years here in the United States. Those are going to change now, and we're going to move to a new philosophy of revenue recognition. Under the new standard, the new revenue model has one core principle, and it's written out here. The major difference is you're going to record revenue based on what you expect to receive from your customers for the goods or services that you've sold them. So that expectation concept is dramatically different from the rules-based criteria that we currently have that flow from those 4 general principles. The new model has 5 specific steps that we're going to follow in order to achieve the core principle of recording the revenue for our expected consideration that we're going to receive for the goods and services that we provide our customers. And we're going to look at those 5 steps now and then contrast some of the elements of those with our current USGAAP. So the 5 steps, these are in the standard. We're going to identify the contract with the customer. We're going to identify the separate performance obligations that are contained in the contract. We're going to determine the total transaction price based on the expected amount that we're going to receive from the customer. Then we're going to allocate that transaction price to the individual obligations, and then finally recognize revenue for each obligation as we meet the performance or delivery criteria of that performance obligation. So I think it's time for another one of our polling questions. Let's take a look at that now, and then we'll dive into the 5 steps in a little more detail. We did have a question about whether there'll be slides, and yes, there will be slides later today that we can be sending, and they'll also be posted to the website along with a recording of the webcast in case you want to repeat it or share it with someone else. So our second polling question is, why are you attending today's webcast? For the information, for the CPE credits, for some other reason, perhaps it's a slow day at work. Let's see what your motivation was for joining us today here at Tensoft for the revenue recognition webcast. Looks like for the information is our leading response so far, and we'll keep the polls open for a few minutes if you get your computer and answer that question. We'll move on with the 5 steps of the new revenue standard. So first we're going to identify the contract with the customer. We typically expect that to be a written document, but there may be different ways of doing business. For example, if you're a website and you just take credit card information. But a contract needs to have commercial substance, so there needs to be something provided to the customer and some consideration received by the vendor. The parties need to have approved the contract. Generally, we'd expect that to be signatures from both parties. However, there's been a lot of discussion, particularly initially, about This may be somewhat of a sea change for cutoff procedures because the standard says the parties have approved it and there's all these identifiable objects or elements of the contract. Under current USGAAP, if the customer signed the contract on December 31st and the company, legal counsel, CEO, whoever signed it didn't sign until January 1st, you'd most likely consider that the evidence of the arrangement took place in January, whereas this standard is a little more less objective, and maybe you could consider that contract to have been approved and therefore binding in December. So, you know, one of those things that's going to be a slight change of our actual guidance. I think most companies will probably still stick with a internal policy of dual signed contracts, but it's just another example of how the rules for revenue recognition aren't going to be so rule-based and are going to be much more principle-based on this core principle and these 5 steps. So to be a contract, there need to be rights and obligations, goods or services provided to the customer. There need to be identifiable payment terms. We're going to have a combination of contracts similar to what we currently have in what we call linked contracts or TPA 39 contracts, where you look to see if separate contracts really are for the same transaction, and therefore even if they're on separate contracts, maybe they're accounted for together. There's that same concept here. Then there's going to be contract modifications. So if in the future the contract's modified, there's going to be slightly different methodologies in certain cases on how you account for the contract. Currently, we generally account for those prospectively. Some of those contract modifications might have retrospective elements. Our second step of the 5 steps is we're going to identify the separate performance obligations. So where we have an element in our current vocabulary, here we're going to say the vocabulary is a distinct good or service, and then we would identify those, list them out separately, and we would allocate revenue to them. So an item is distinct if it's sold separately, so this is our existing concept of standalone value with a different name. It's distinct if the customer can benefit independently of the other elements or can combine that particular obligation with other resources to benefit from it. And again, similar to what we do currently, if they're performed together or they can't be separated, we treat them as one obligation. So we will have a little bit more leeway, much the same way as when we got 08-1, the relative selling price method, and we got some more tools for separating elements and valuing, and that concept is present in this standard as well. Then you're going to determine the transaction price. This is where we determine how much revenue do we have to allocate to the various obligations within the contract. And this is a major departure from our existing revenue recognition principles under GAAP. Current US GAAP, we have this concept of fixed and determinable amount, and if you have contingent revenue or contingent reductions of revenue, you look at them net and record the revenue for those at a later date when there is a resolution of that contingency. Here, we're going to record as revenue the amount that we expect to be entitled to. So this is a much different clarifying principle. We are going to look at what we expect to receive and record that. We're also therefore going to record variable considerations. So if there are penalties or bonuses that would make the revenue go up or down, we're going to consider those, but we're going to look at what our expectation at the outset of the contract is. So if there's a penalty clause, for example, in the contract, where currently under our US GAAP we'd be deferring the potential penalty. Here we would make an estimate of what we really expect to happen and record that amount, even if it was greater than what we would currently record under US GAAP. Similarly, if there are bonuses or other upsides, we would take those into consideration, and you would record those at the outset of the arrangement rather than waiting for future events. As part of our determination of the transaction price, we're going to consider the time value of money, where we currently don't generally do that in USGAAP. Here we would be, and the bright line on that is if the transaction or the payments and the events of the transaction take place over a period of greater than 1 year, then you're going to potentially have to take into consideration the time value of money. Also included in the transaction price determination is any non-cash consideration. And then, of course, similar to what we have currently, if there is going to be consideration that's paid to the customer, you need to consider that as well as to whether that's going to be a reduction of the revenue. That's similar to our current concept. So after we've determined what the contract is, determined what our obligations are, similar to our elements of multiple element arrangements currently, we determine the price that we're going to have, we expect to receive for that transaction. Now we're going to allocate that transaction price to the obligations. We're going to determine the distinct selling price of each item or the standalone selling price of each item, and then use a relative selling price type methodology to allocate the revenue to each one of the elements. We're going to estimate the standalone selling price if it's not readily available, for example, using some kind of market assessment approach or a cost plus margin. There is an option in this standard to use a residual approach if one of the elements is highly variable or uncertainty and you've got adjusted market approach or a standalone selling price for the other elements. You may be able to use the residual approach to determine the value that you would be allocating. Then you're going to allocate the revenue to the various obligations similar to what we do in the relative selling price method. However, in our relative selling price method under current USGAAP, we don't take into consideration discounts as allocated to a particular item. We look at the revenue as a whole, including the discounts of the contingent revenue. Here, if a discount or a contingent revenue element can be determined to be related to a specific contract obligation, then you may apply that discount to that contract obligation and show the relative selling price calculation so that the amount of revenue allocated to that one element is reduced or increased depending on the facts and circumstances. So that's a departure from our current relative selling price methodology. And then once you determine your allocation methodology, you're going to use that to make any adjustments in your expected contract price after you've done your initial recording of the transaction. So one thing that's really different from current USGAAP, where we err on the side of conservation so that we never have to go back and reduce revenue, we only increase it in future periods. Under this new methodology, because you're making estimates about the expected value, and that estimated expected value could change both by going up and going down. If it goes down or up, you're going to use that same methodology to allocate that difference to the elements or the obligations as you did in the initial contract allocation. So that's our fourth step. We're going to allocate our transaction price to our obligations. And then finally, step 5, we're going to recognize the revenue on the satisfaction of each individual performance obligation. So as we perform it, as we deliver it, we will recognize the revenue related to that under two methods, either at a point in time or over a period of time. So we do that currently, but there's going to be some different rules about the determination of whether you're recognizing revenue at a point in time or whether you're recognizing revenue over a period of time. And the general concept here is, rather than specific rules, is an obligation is satisfied when the vendor transfers control of the good or service to the customer. Currently, we sometimes recognize revenue separately from the control, for example, under the percentage of completion method, where maybe the customer doesn't actually take control of it until the end, but we recognize revenue in advance of that as we do the work. Also, sometimes, for example, in bill and hold arrangements or contract manufacturing, other areas, we wait until we actually deliver the goods, even if we put them under the control of the customer at an earlier point of time, say in a segregated warehouse or while it's in work in process. That is going to be a different, there's going to be a different methodology because we'd be working here on when control actually transfers, and we'll talk a little bit more about that. So that's our 5 steps to revenue recognition under the new revenue recognition standard. And as we said, this control transfer is an important concept of the point in time that we're going to recognize revenue for the revenue that we've allocated to a particular performance obligation. And the guidance in the standard is control is transferred to the customer over time, as opposed to a point in time, when an asset is created or enhanced and the customer controls the asset or the enhancement or has access to its utilization. And if no asset is created, but the customer receives or consumes the benefit, then control has been virtually transferred to the customer in the form of use. Or in cases where maybe we're doing some customization work or building something for the customer, if another entity wouldn't have to go back to zero and start over, but could take over the project and utilize the work that's been completed to date to complete the project or fulfill it, then maybe we meet the criteria for recognizing over time rather than at a point in time. In any case, the vendor has to have a right to the payment for the performance completed to date and needs to have, again, meet that expectation requirement that they will receive the payment. So there's some of the aspects of transfer of control that we're looking at. Control is transferred at a point in time when it's a physical item and physical possession is transferred, when the customer receives the legal title to the asset, similar to our delivery requirement today, and the vendor has a right to the payment for that asset. The risks and rewards of ownership have transferred to the customer, and if there's acceptance terms that the customer has actually accepted the asset, the good or service that have been provided or are the subject of the performance obligation that the vendor is passing on to the customer. Now we're going to look at, do a little compare and contrast of some of the elements of the new standard compared to our existing revenue recognition model. Before we do that, let's get another polling question in here so those of you interested in the CPE credits can receive those. And so our polling question coming up here. Here we go. How did you hear about today's event? Did you get an email from Tensoft? Did you see something on LinkedIn? We're very active there. Did you view a Google ad? Did a friend or colleague recommend it to you? Or did you find out through some other methodology? We're very interested in how you learn about and participate in these webcasts. So while we're getting that, looks like the majority of people are on the Tensoft email list, and that's how they found out about it, and that's consistent with our prior webcasts. So let's take a look at some of the differences and similarities between these two models. So our current USGAAP revenue recognition model, delivery, we've got this substandard performance criteria, risk and rewards passed to the customer, acceptance from the customer, either at a point in time or over time, and then of course all the various multiple element arrangement rules that we have. Under the new model, a lot of similarities, goods or services when they're transferred to the customer, although this transfer of control concept is slightly different because we need to meet those criteria, rights to payment, either passage of legal title, physical possession, risk and rewards, customer acceptance, or how we met a virtual sort of transfer of control concept. Not too different, other than in some cases on the transfer of control concept. So on collectability, under the current revenue recognition principles, collectability is our fourth principle, must be collectible to recognize. You defer the entire amount if it's uncollectible or not reasonably assured, and recognize revenue on a cash basis if collectability is a concern. So in the discussions of the new model, there was a lot of focus on this particular aspect of our current revenue recognition model because often it doesn't really reflect the economics of transactions. If there's some concern about the collectability of a consideration from a contract, most companies wouldn't be entering into that transaction if their expectation was zero. But that's what their financial statements record. So under the new model, you look at a credit risk. Collection needs to be probable, and there's some differences between the definition of probable in IFRS and USGAAP, but generally if you're in the 70–80% certainty or probability of collection, you would meet that standard. Rather than going to an all or nothing sort of model as we do now with the cash basis, if there's collectability concerns, you'd recognize the amount you expect to receive rather than making it binary and only recognizing revenue as the cash was received. However, if you're in that, top 10–20% of the probability expectation of not receiving it, then there's a question of whether you actually have a contract if you don't seriously expect to receive the revenue. So this is a major difference between our current revenue recognition model and the new standard, because we will see companies that have currently deferred all the revenue from a contract and are recognizing on a cash basis as the payments are either received or on their due dates, will move to more of an upfront revenue recognition based on what their expectation is. And of course, this is one of those areas where what best practices and standards of documentation of what expectation is based on your history and individual customer assessments will be. But in general, I think we're going to see a lot more revenue recognized up front rather than deferred in its entirety. For example, if you had an 80% expectation of payment on a transaction, you'd recognize that 80% rather than zero, as you do now when you have collectability concerns. Of course, one of the issues with this, of course, was most companies, if there's collectability problems, often find that they're sort of in an all or nothing collection methodology rather than getting a percentage. But this is where we've moved in the new standard on credit risk and collectability. It needs to be probable, and you're going to record the amount you expect to receive at the outset of the arrangement rather than having this higher standard of our current guidance. One of our current principles, of course, is fixed and determinable revenue. So we recognize only the fixed and determinable amounts. We recognize the net revenue. We net out any potential penalties, any reserves that we have to do, any contingent revenue. We defer all those and recognize them when they occur. Any potential increases, we recognize when they would occur, even if we're highly confident we would receive those amounts or meet the deadlines in our contract. Contrast that with our new methodology under the standard will be we're going to recognize the expected amount. We will estimate what we think we're going to get from the contract, and we will recognize that amount, even if it's in excess of what we're entitled to bill at the moment. I know a lot of companies, when they're doing the relative selling price method, have this cash cap concept where if you've only billed a certain amount, that's or only entitled to bill a certain amount, that's the upward limit on what you can recognize for revenue recognition. That's going to be dramatically different. You will estimate the total amount that you receive, and if that's in excess of what you're allowed to bill and put on your AR, you will record a unbilled amount or a work in process. You'll create an asset on your on your books, similar to accounts receivable, for the unbilled amounts that you expect to receive under that contract, even if those are amounts that are greater than the amount you're contractually able to bill at the current time. And again, you're going to base this on your expected value that you're going to receive from the contract. So if there's variable considerations in there or estimates that you need to make, you're going to make your estimate based on the most likely amount or your expected value. You're going to estimate any variable revenue, and you're going to record that amount of revenue on your books, both as accounts receivable and unbilled. And if in the future periods you have adjustments up or down, then you will make those adjustments as your estimates change. So if you estimated that you would receive $1,000 from a transaction and recorded that, and later determined that the amount really is only going to be $900, you'd have a catch-up debit to revenue of $100 in the period when you made that, when your estimate changed. Unlike now, where you would only record the $900,000 or the $900 in the initial period based on your estimate, based on your fixed and determinable amount. So this is a really different concept and a very different results for revenue recognition, particularly from a timing or a period that the revenue is recognized. I think at the end of the day, when all the transactions are done, we're going to be recognizing the same total amount of revenue for each transaction, because it's going to be the amount that the company actually receives or gets paid, but it's going to be a very different result in the initial periods, and it's going to require a real mindset change from us as revenue recognition accountants, because we're so schooled in this only the fixed and determinable amount to recognize. We talked about whether we recognize revenue over time. Currently we have a straight line, a proportional performance concept. We've got a percentage of completion based on estimates and enforceable rights. We move it to doing that over time if control is transferring to the customer as we do it, or if there's no alternative use and we meet these other requirements that the customer could benefit from it, another entity wouldn't have to re-perform it. If not, there'll be some companies that are currently recognizing revenue over time that will move to recognizing at a point in time, typically on a completion method. And this is one of the few areas in the new standard where we're going to move to a later revenue recognition point rather than moving revenue recognition to an earlier time. Our point-in-time revenue recognition is generally the same, other than those exceptions that we've talked about when we've transferred something to the customer. Although under our current, smorgasbord of revenue recognition methodologies, for example, software revenue, we may have undelivered elements that we don't have estimated value or VSOE for that we're deferring for, which we wouldn't be doing under the new standard. Contract modifications, typically we do accounting for contract modifications under USGAAP on a go-forward basis, and look at changes in estimates and concessions as they occur under the new methodology. We're going to record the expected amount, and if the contract is modified or changed, we will adjust the existing contract unless it's a new contract, and it's considered a new contract if the additional goods or the new goods and services are distinct and consistent with standalone selling price. So if you do contract follow-ons that have significant discounts in them or items that aren't distinct from the initial contract, you may find the initial contract price allocation changed, and maybe you'll have either a catch-up or a catch-down in the period when you do the modification. So there's some very different results under contract modifications under the new model. Determining what the value of the elements are, besides the determination of the total value that we had, where under current model we use fixed and determinable, and under the new model we use expected value, we're going to be doing all of our revenue recognition allocations based on a market assessment approach or a relative selling price methodology. And we're going to determine the value very similar to what we're doing now with our relative selling price method, only there's really only going to be one methodology. There's not going to be the hierarchy that we have currently of VSOE, vendor-specific objective evidence, third-party evidence, and estimated selling price. We move to this distinct value approach, the standalone value, and have some different methodologies of coming up with that. One difference is that this residual method may be used in certain circumstances where it's prohibited under the relative selling price method we're currently using under EITF 08-1. And then, of course, currently we have the VSOE concept in software, and that goes away. Software, you're going to have to estimate or come up with the value of both your licenses and your services and your support, unlike currently where you use the residual method, have VSOE for the undelivered elements, and record the residual amount for the delivered elements. And as we said, so we've got, instead of a variety of allocation methodologies, residual method, industry-specific relative selling price method, we've got this relative standalone selling price methodology under the new guidance. Our current license and software models for revenue recognition, when the item's been delivered, when the lease term, or when the license term rather begins, different revenue recognition methodologies for different industries. For example, biotech is different from software currently, but you're doing it either over time or at a point in time. The new model, when the license begins, but this concept of definition of which licenses go over time and which licenses are at a point in time. So a dynamic license is recognized over a period of time. That's a license where the vendor has to do things to enhance or maintain it over the license period, similar to a license that has embedded support or maintenance with it, but also looking at licenses of things like a brand. And the example that you hear frequently is if someone gets to be a sponsor of the NFL and put their logo on their website or on their stadium or you know, on goods that they sell, the NFL has to stay in business for that license to have any value. If they stopped playing games and there were no more Super Bowls, that license wouldn't have any value. So that's considered a dynamic license. The other license concept is a static license. That's very similar to a perpetual license that we have now of either software or intellectual property, where you hand it over to the customer and the vendor is done. Those type of licenses are going to be recognized at a point in time. And there may be some differences for different industries and different types of licenses that we may be recognizing currently. For example, a lot of term licenses in the software world are recognized over time, but they may be considered static licenses if the license itself is delivered to the customer and the vendor obligation is done and there's a separate support and maintenance obligation. Then we may find situations where that license would be recognized at the initiation of the license period and on delivery, as opposed to over time, as it currently is. We talked about the time value of money. Currently, it's not generally an element for revenue recognition, but under the new standard, you're going to need to consider whether there's a significant financing component, and what is significant, what's a financing component. A lot of people are working that through right now, but generally, you're going to have to take into consideration the time value of money if your transactions are greater than 1 year and your payments are either upfront or in arrears. There may be implied interest expense or interest income related to that transaction as opposed to just recognizing the nomination, the notational value of the payments. Disclosures, we have general disclosures now in our financial statements for revenue recognition and very specific requirements about what you do for multiple element arrangements, how you come up with the values, what methodologies you use, if you've got non-monetary transactions or bill and hold, and then the various industry requirements. Under the new disclosures in the new standard, lots more disclosures, because if you've got significant judgments and estimates that you're making as part of your determination of what the expected value of a transaction is. You're going to need to disclose those, and there may be lots of different categories that you have to give much more specific disclosure and guidance on how you do those. You need to talk about what kind of contracts you have with customers, similar to what we do now, how you're accounting for them, what kind of assets you're recognizing from costs, because one of the requirements of the new standard is that costs incurred to acquire a contract, for example, commissions, in most cases are going to be recorded as assets and recognized as costs over the revenue recognition period, as opposed to now where we recognize most of those up front as expense. And then there's going to be more disclosures and details about your reconciliation of your revenue balances, how much came from deferred revenue, what's the nature of your deferred revenues, how much came from changes in estimates, just a lot more disclosures that you're going to need to track information for and include in your financial statements, which are going to be a little longer, at least the revenue recognition footnote. We've got about 5 minutes left. We're going to go over some of the impacts to companies, but let's do our final question for the polling questions today. And I think I know what it is if we can get it up, and that is our first question that we asked. Oh, here we go. How do you currently manage your revenue recognition? Are you using spreadsheets? Does your ERP system do it? Have you got some revenue recognition software like Tensoft, either as an add-on module or something in your ERP system, or do you use some other methodology like a Post-its or something like that? So while we're getting that, that's real interesting to us because we do have revenue recognition that works with you to do your revenue recognition. So when we look at the effects of these changes that are going to be on companies, one of the first ones is adoption. Which methodology you're going to use? Are you going to use the retrospective, or are you going to have to restate your prior financial periods, or you're going to do the simplified transition method? You're going to move to one methodology for all your contracts. Do your ERP systems, your accounting systems, are they able to handle all these estimates and this change in methodology? I know a lot of companies are just getting caught up on the changes to the relative selling price method, and these are going to be similar to those, only with a little bit different finessing of what the amounts are. For example, the contingent revenue concept goes away. You're going to have to revise your revenue recognition policies and procedures. Your internal controls related to those are all going to change. You're going to have to participate in the evolution of the application of this new standard and the development of best practices. You're going to need to be ready for the acceleration of revenue. One thing we haven't talked about, but on the transition date, when you, in particular if you use the simplified transition method and you restate your balance sheet, any deferred revenue that was deferred because of the existing USGAAP that isn't deferred under the new standard will vanish. It'll just go to an adjustment to your retained earnings as part of your transition balance sheet. And so you're going to have revenue that you'd expect to receive in future periods that, based on the deferral, that's going to evaporate, much the way it does in a purchase transaction. The other thing is we're going to have to move to this much more flexible principle-based system of making estimates as opposed to having objective values. We're going to, in our allocation methodology, similar to the relative selling price method, we're going to have estimates for all elements. We can't use the residual method. We've got this transfer of control issues that may impact us on our revenue recognition over time. We've got a difference in our collectability, our expectation versus probable. Software companies are going to move to a completely different methodology, the relative selling price method, and the residual method's only going to be available for one item in the allocation calculation. You're going to have to consider your compensation plan changes, because if you've got comp plans that are based on revenue and your revenue recognition changes, maybe need to change your compensation plans to reflect that. You're going to be working with auditors and regulatory agencies like the SEC that are going to have a changing concepts of how revenue is recognized. If you've got debt covenants or other contractual reporting requirements, you need to look into those because your financial statements may change dramatically and may cause you to differ from your current methodology of determining whether you're in compliance with regulatory requirements or debt obligations or other contractual arrangements. So you really need to be looking at your contracts and all of your your financial reporting requirements. Again, we're going to be much more robust in our disclosures for our financial statements. And some of the things you need to consider, remember when we started out, we said these new rules are independent of U.S. adoption of IFRS. They're going to be GAAP when the rules go into effect, which is 2017. It's not a matter of if, it is a matter of when. Determining whether you're going to do the simplified transition or the retrospective adoption method is going to be a major consideration. And you know how a lot of CEOs or CFOs think they're going to say, why don't you just do it both ways and then we'll decide. So, and the various considerations there of what you're going to be doing as far as how you forecast for your future revenues, both for internal purposes and for external purposes, are going to be really impacted by how you manage this transition adoption. I know a lot of people that I talked to initially thought they would go with a simplified transition methodology because they thought that might be easier, but when they start to look at it and realize all the changes that's going to ripple through the organization, waiting that long to really determine all the impacts of the change may be too late. Your accounting system most likely will not be able to handle this unless you're doing everything on Excel. You're going to be moving to a new accounting system, and if you've got to implement a new ERP system, sometimes the timeline for that is 1.5 to 2 years anyway. You may be cutting it close on working that. So your current systems, may not work under the new model. You really need to plan ahead. So what do you need to do? Well, first you need to understand the new revenue recognition rules, and I think that's going to require not just coming to webcasts like this or going to classes or reading some of the updates from the various accounting firms or the new guidance that's coming out. I think you're going to have to take a copy of 605, take a copy of this new revenue standard and read through it. It's about 600 pages in total, the standard that I downloaded from the FASB. A good part of that, maybe a couple hundred pages at the end, is just a copy of 605, our current revenue recognition standard with the things struck out and the new standard put in. But there's going to be a significant effort on an revenue recognition accountant's part to understand these new rules. Once you start to understand them, you're going to have to assess how is it going to affect your company. What revenue streams do you currently have that are going to be accounted for in a different manner under the new standard? You're going to have to form some sort of implementation team that's going to have to be broad-based within your organization, including finance, accounting, your HR, your sales team, your investor relations, anybody that deals with the financial statements, your legal team for how you structure your contracts, your marketing team, how you're going to go to market with your products. All that may change. You're going to have to assemble these resources and get budget for that. If you wait to the end and you're looking for additional resources because, hey, everybody in your accounting department's kind of busy right now and you're going to do an additional level of work, you may need additional resources. You wait till the last moment, they may not be available. Then you're going to have to determine your adoption method and look at what sort of system changes and policy and procedures changes you're going to need to do, and you're going to have to educate everybody. Yourself, management, senior management, sales, as I say, HR, your finance, your board of directors, your auditing committee of your board of directors, your shareholders, the investment community, your customers. Anybody who looks at your financial statements needs to understand how that's going to be impacted. And now that the standard's out, if you're a public company or a private company, when you issue your next set of financial statements, you've got to make a disclosure about how you think this new standard will impact your company. And of course, initially, you can have just disclosure that it has been issued and you're evaluating it. But as you move forward, you're going to have to get more distinct evaluation of what the impact's going to be, because that's one of your requirements for disclosure. So we've gone over time a little bit. Again, if you've got any questions, please send them in, and we'll try to get back to you either by email or by posting them on our blog. Here's some of the resources you can look at. A lot of stuff is out there. If you do a internet search for the new revenue recognition standard, all the major accounting firms have guides and updates. There's white papers that are out there, or update guidances. The ISCPA has this transition resource group. The Journal of Accountancy July issue has a very good article on this. The FASB website has the new standard and some guidance about its implementation. Look at the SEC filings of companies that are adopting it or disclosing it. Again, webcasts like this one and web searches are all things you can do. Here's my email address. Thank you so much for joining us today. Do we have any questions I can answer real quickly, or we're too far over? Okay, sorry about that. It's a really vast topic to even introduce in an hour webcast. So thank you very much for joining us today, and look forward to our next webcast here at Tensoft.